new LinkedIn Hiring Pro can't undo your last hire, the no-show. Who set you back because they didn't show up on day one, or day two, or ever again. And now your product launch is delayed because you're talking to alien abduction podcasters to track them down. But LinkedIn Hiring Pro can help make sure your next hire sticks. In fact, businesses who use LinkedIn are 24% less likely to reopen a role in the next 12 months. Hire right the first time with LinkedIn Hiring Pro. Post a free job today at linkedin.com/quality.
Morning decisions. How about a creamy mocha frappuccino drink? Or sweet vanilla? Smooth caramel maybe? Or a white chocolate mocha? Whichever you choose, delicious coffee awaits. Find Starbucks Frappuccino drinks wherever you buy your groceries.
Welcome to Markets Radar with Jeremy Quintanilla. This is a show about markets, stocks, bonds, crypto, foreign exchange, private equity, and everything in between. And I give you my take on what it all means. This episode is being recorded on August 8th, 2026. By the time that you hear it, some of the news may have changed. And if you are new to this show, this is on my podcast feed, Age of Jeremy. We will be eventually moving it to its own podcast feed as we enhance the production of the show. So be on the lookout for that and make sure that you like and subscribe and share it with as many people as possible so we can get them in front of good news about markets so that they can take advantage where they see opportunities to invest. And that is the goal of what I'm trying to accomplish here. You can follow me everywhere on social media at Age of Jeremy. If you like Instagram, go ahead and sign up for my broadcast channel. It's absolutely free. It's called Dope Insights and Updates, and we're working on creating some more content for that feed as well. If you are also new to listening to this show, you know that I own a business called 3T Warrior Academy, where we have helped thousands of warriors, actually tens of thousands of warriors over the last, 8, 9, 10 years now, helping them understand how to navigate the crypto and regular markets. And we have a trademark pending process called CapDR, and CapDR is all about understanding how you can use cash flow to take that cash flow, put it into assets that appreciate, exit out of those assets by de-risking, putting it into something like index universal life insurance, which allows you to leverage the equity into that account to then start the process over again. We call it CapDR. If you are interested in that, head on over to 3twarrioracademy.com or go down and check out one of the links in my episode description. There will be a link to my link tree and you can access it there as well. But with CapDR, it's changing the way in which you understand how to use cash flow to build a long-term generational wealth. So I feel that it should be a part of everybody's portfolio, process, would be the way that I want to say it. So again, I'm biased because I use it and I helped create it with CJV. He's the one that really coined it and made it into a really strong process. So make sure that you check that out. But getting into these markets, because that's why we're here, by closing bell on Friday, August 7th, the S&P 500 capped off a massive week by surging 0.6% to secure its 26th record-breaking close of the year. For the week, the index rose a stellar 3.6%, but the real star of the show was the tech-heavy NASDAQ Composite, which leaped 1.3% on Friday to finish the week up an incredible 5.2%. For both the S&P 500 and the NASDAQ, this represents their biggest weekly performance since April. Meanwhile, the blue chip Dow Jones Industrial Average added 152 points, or 0.3% on Friday, to lock in a solid 3% weekly gain. It is an incredible turnaround, especially when you consider how much markets have been whipsawed recently. Investors have spent weeks sweating over the sustainability of the artificial intelligence trade, which we've been talking here for the last couple of months on Markets Radar. And they have also looked over the sustainability and escalating geopolitical tensions, particularly the conflict between the US and Iran, which seems to be going back and forth. But on Friday, all of that anxiety was pushed aside by a single economic data set. In a classic case of Wall Street's bad news is good news logic, the primary catalyst for this record-breaking run was a surprisingly weak July jobs report. The US economy unexpectedly lost 23,000 jobs in July. To put that into context, Wall Street economics were projecting a gain of 83,000 jobs. That is a massive miss. On top of that, we saw steep downward revisions to prior month's data, which efficiently wiped out 103,000 jobs that we thought had been added in May and June. Interestingly, the unemployment rate actually ticked slightly lower to 4.1%, but don't let that fool you. It didn't decline because of hiring. It fell because more Americans stepped back from the labor market entirely, removing themselves from active workforce calculation. So essentially, when you're looking at jobs report numbers, you essentially, the economists look at, or the people looking at the data set, they look at how many people have been filing for unemployment, how many people have been putting in those jobs. And essentially what ends up happening is there is a point where people just don't apply anymore because they've lost the interest in joining into the jobs market, right? And then those people don't get counted moving forward. And then that's what can lead to the labor market falling. And so the other thing that we want to look at, though, is so why did the stock market throw a party on a negative job growth number? Because for months, markets have been pricing in at least one more interest rate hike this year, driven by sticky inflation and highly volatile energy prices. Friday's soft job reports instantly flipped that script. Suddenly, the threat of restrictive monetary policy eased, according to CME Group data. Interest rate futures now show a 58% probability that the Fed stays on hold at its next meeting, with the chance of a rate hike falling to 42%. As Michael Hans, Chief Investment Officer at Citizens Wealth, put it, this soft report takes some of the hike rhetoric off the table and signals that the market shouldn't be pricing in aggressive rate hike action anymore. So essentially, the investors up until this happened thought that there was going to be a rate hike coming in the back end of the year, maybe even two. And so with the soft jobs report number, it makes the people that are investing feel unlikely that there's going to be an interest rate hike. However, I do believe that still in Q4, we are going to get an interest rate hike. Treasury yields, which move inversely to prices, fell sharply. The policy-sensitive 2-year Treasury yield slipped to 4.203%, while the benchmark 10-year yield declined to 4.65%. The drops in yield acted like a pressure valve releasing for battered tech stocks, which immediately started regaining ground. Now, the Philadelphia Semiconductor Index is now up more than 9% so far this month, and NVIDIA had a fantastic week. Shares of the chipmaker rocketed 12%, adding $562 billion in market capitalization. According to Dow Jones market data, that marks the largest weekly market cap gain on record for any company in history. But this really isn't just about the rate speculation and the tech hype. It's also being supported by actual hard dollar corporate earnings. The Q2 earnings growth rate for S&P 500 companies currently stands at an eye-watering 50.4%. If that holds, it will be the highest quarterly growth rate since the second quarter of 2021. As Mark Malik, Chief Investment Officer at Cybert Financial, noted, the recent market pullback made stocks look attractive again, and this earnings season has vastly exceeded expectations. Now, what does that mean for the future? In my opinion, we are still in a situation where we don't know what's going on. And when people don't know what's going on, their emotions tend to put them into I want to say putting them more into an investing mode because there's more volatility, right? Volatility in markets is our friend. So right now, because there's so much back and forth on what's going with Iran, what's going back and forth with whether artificial intelligence is good, what's going on with the United States doing more IPOs. And so people want to be a part of that marketplace, so they're putting money into it. That doesn't mean after the midterm elections going into next year that that's going to continue to withstand itself. And so my prediction still is that we will have a recession going into the back end of the year, and if not, back end of 2027, back end of 2027, and then going into 2028, there will be also a recession. Also, Michael Burry, famous for The Big Short, also started shorting the AI industry as well, and there are some ETFs out there that could help you short that specific position without getting into specifically shorting stocks. That's one of the reasons why I like ETFs, even though there are costs associated with it. ETFs are a way to strategically purchase a asset similar to a stock, the way that you would like buying Coca-Cola or something. You could buy an ETF and it gives you access to a specific strategy. And that's why, in my opinion, one of the best financial instruments that have been made in the last 20, 30, 40 years are how we have used ETFs to do that, specifically for sectors and or for strategies. Now, when we look at the labor market, how can we reconcile a contraction where the U.S. actually lost 23,000 jobs, right? Which again, some of those jobs were counted for as loss. We also looked at how many people were still continuing to look for jobs. But with stock markets hitting all-time highs, is this bad news? Is this good news? Dynamic? Is this a bad news or good news dynamic? Is it truly sustainable foundation for an actual bull market? Or in my opinion, we might be going into a bear market in the latter half of 2027. It makes sense when you look at what has been choking this market. So the threat of the Federal Reserve keeping rates elevated or even hiking them further to fight inflation. By showing a contraction in jobs, this report signals that the labor market is cooling, which directly takes aggressive rate hike rhetoric off the table. But I still think that going into Q4, I think there's a rate, there could be a rate hike in the end of Q4, like in the November, December, I can't remember when they do it, in the December timeframe. The bad news is good news dynamic has a very short shelf life. In the short term, lower treasury yields and 50.4% corporate earnings growth are supporting stock valuations. But if the labor market continues to deteriorate, those job losses will eventually hit consumer spending. And once consumer spending drops, corporate profits will follow. And for now, the market is riding the relief of a paused Fed, but a real economic recession is never good news for stocks in the long run. And again, I'm still going to go this, and I hope that I'm wrong, but I think that we're going to go into a recession and the economy is going to be hit hard in the back end of 2027 going into 2028. The other thing that you could watch out for, or there are specific types of indicators. So there's a Bank of America's bull and bear indicator, and it's been hitting extreme levels. And the July Consumer Price Index report scheduled for next week, are we getting too complacent, and what are those immediate risks? So the risk of complacency is incredibly high right now. Bank of America's bull and bear indicator recently climbed to 9.7% from 9.4. It's the highest level since 2021. Historically, when investors' bullishness reaches this kind of extreme, crowded peak, a sharp market pullback follows. That's why Bank of America strategist Michael Harnett is actively advising investors to trim risk assets and rotate its defensive rate-sensitive areas like consumer staples, REIT, small cap stocks, biotech, and the US dollar. And in that regard, I have actually, in my actual retirement portfolio, that's a traditional IRA. I also have a Roth IRA. Well, actually, I have a traditional IRA. I can't have a Roth IRA, but there's a backdoor way to get into a Roth IRA, but we're not going to go into that right now. And so in my traditional IRA, I actually have been putting all of the money the new money that's coming into that I put in on a regular basis to get that portfolio to a specific amount. I've been putting that all into the Spider Shares Consumer Staples. I've been pumping that in for the last couple of months, and I'm going to continue that until I see that we are not overly crowded in the marketplace, which is what the Bank of America bull and bear indicator says. Because when that happens, that means that it's that sentiment when even there's a saying where JP Morgan was someone was getting their shoes, or John F. Kennedy's dad or somebody, they were getting their shoes polished, and the kid who was polishing the shoes started talking about stocks and getting into the stock market and taking, on what he thought about a specific stock, and making a bet on that stock, right? When we get into the place where everybody's talking about something, that's when you can get the sentiment that we're overcrowded in the stock market. Not saying that those people shouldn't be taking advantage of the stock market. They absolutely should. But when there's so much stuff happening where people are consistently talking about it, it means that there's more money going into it. And that's when you have a crowded marketplace. So again, be cautious and maybe start looking at consumer staples, small cap stocks, biotech, and REITs. I wouldn't put your money in the US dollar. I'd put it somewhere else, or into like a treasury bond or a municipal bond ETF that tries to keep up with inflation. That's what I use. I use a Charles Schwab one. And then it also, you don't pay taxes on it because it's a municipal bond. So again, the ultimate test is going to come this upcoming week with the July CPI inflation report. As Bradford Smith of Janus Henderson warned, a hot inflation point would very much increase the probability of a hike in September. If next week's inflation data comes in hot, it will completely upend the market's expectations that the Fed is on hold. The margins are thin, valuations are stretched, and next week inflation print will decide if this record run has legs. We'll be right back.
The new LinkedIn Hiring Pro can't undo your last hire, the no-show. Who set you back because they didn't show up on day one, or day two, or ever again. And now your product launch is delayed because you're talking to alien abduction podcasters to track them down. But LinkedIn Hiring Pro can help make sure your next hire sticks. In fact, businesses who use LinkedIn are 24% less likely to reopen a role in the next 12 months. Hire right the first time with LinkedIn Hiring Pro. Post a free job today at linkedin.com/quality.
We are officially witnessing the dawn of a new era at Berkshire Hathaway. Since Greg Abel succeeded the legendary Warren Buffett as chief executive back in January, the entire investing world has been holding its breath, asking one central question. How will Abel handle the pressure of managing Buffett's half-century legacy? And more importantly, what is he going to do with Berkshire's legendary mountain-sized effing cash pile? Actually, I think I might have like a little noise thing for this. Let's see if it works on here. Nope, nothing. Okay. Oh no, maybe there was. Oh yeah, listen to that. Listen to that beautiful cash sound. That is a horrible, horrible cash sound. And I still can't hear it, probably because I don't have headphones plugged in. Anyways, not important. Let's talk about Greg Abel and what's going on with his cash pile. Hope that doesn't hurt your ears. We'll have to make sure we fix that loudness in post. Yes. Well, this weekend we got an answer on what he's going to do with that cash pile. Berkshire released its second quarter earnings report, and the data shows that Greg Abel is not content to simply sit on his hands and let the idle cash gather dust. He is actively putting his own stamp on the conglomerate. For the first time in years, Berkshire is aggressively putting its money to work, even in a market that many value investors consider highly overstretched. And I'm one of those value investors, but that doesn't mean you can't still make money. Let's start with the headline grabbing numbers. For the first time in more than 3 years, Berkshire Hathaway's cash haul actively declined sequentially. After accounting for a payable for purchased short-term government debt, Berkshire ended the month of June with $364.7 billion in cash and treasury bills. Now, $364.7 billion is still an almost unfathomable amount of liquidity, but what's critical here is the direction. The figure represents a 4% decrease from where the cash pile stood just 3 months prior. To put that into perspective, this is the first sequential decline in Berkshire's cash stockpile in 4 years. The steady accumulation of cash that characterized the final years of Buffett's day-to-day capital allocation has officially paused, and Abel is buying. And he didn't just dip his toes in the water, he went on a genuine spending spree. During the second quarter, Berkshire became a net buyer of equities for the first time in more than 3 years. The conglomerate purchased a massive $23.5 billion in equity securities while selling just $3.7 billion during the same period. First, Abel orchestrated a major corporate acquisition, completing a $6.5 billion purchase of the homebuyer Taylor Morrison home. This represents one of the largest outright corporate acquisitions Berkshire has purchased in recent years, signaling a continued bet on the long-term fundamentals of the American housing market. But Abel didn't stop there. He also made a massive, high-profile move directly into the technology sector, deploying $10 billion into Alphabet, the owner of Google, which is where I've been putting my money for months and years. This because I am betting big on Google, and Sundar is a fantastic CEO, and I love everything that Google is doing. You will make money by putting your money into Google. The multi-billion-dollar bet on Alphabet has instantly elevated the tech giant into Berkshire's elite circle of largest holdings. As of this quarter, Berkshire's core equity portfolio is now heavily anchored by Alphabet. It is also anchored alongside American Express, Apple, Bank of America, and of course, Coca-Cola. It is a massive statement of confidence in big tech, and we are set to get even more specific details on how those stock purchases shook out when Berkshire releases its full regulatory filing next week. On top of acquisitions and public equity investments, Abel has also turned the capital inward during May and June. Berkshire spent roughly $4.5 billion repurchasing its own shares. That buyback program swallowed up 478 Class A shares and more than 8 million Class B shares, demonstrating that even at current market valuations, leadership still views Berkshire's own stock as a highly attractive place to park cash, and it is. All of this aggressive capital deployment coincided with an absolute blowout quarter on the financial statements. Berkshire's quarterly net income more than doubled, skyrocketing to $25.67 billion or $17,868 per Class A shares. Compare that to the $12.37 billion or $8,601 per shares that the company reported in the same period last year. Now, as seasoned Berkshire watchers know, net income in any given quarter can be highly misleading. Warren Buffett famously spent decades advising shareholders to ignore short-term fluctuations in net income. Because of standard accounting rules, Berkshire is required to include unrealized gains and losses from its massive stock portfolio in its net income figure. This means that a highly volatile stock market can artificially inflate or depress the bottom line on paper, even if Berkshire's underlying businesses are performing steadily. That is why Buffett always pointed to operating earnings as the true yardstick of Berkshire's operational health. Operating earnings strip out those volatile paper-only stock market swings, and by that measure, the second quarter was an undisputed triumph. Operating earnings rose 16.3% to $12.98 billion, up from $11.6 billion a year earlier. This strong performance was heavily powered by Berkshire's industrial and retail divisions. Profit from the company's portfolio of manufacturing, service, and retailing businesses, a diverse group that spans industrial metal components, Duracell batteries, and Flying J fuel stations, jumped an impressive 24 to $4.47 billion. This surge in industrial and retail profits was more than enough to offset a slight cooling in Berkshire's insurance division, which saw a drop in underwriting earnings weighed down by results from car insurance company Geico, as well as a decrease in insurance investment income. But it is an incredibly strong, resilient operational performance, and as Greg Abel begins to aggressively deploy his capital, it raises a profound strategic question for us as investors. Here's the question. Given that major value investors are describing both public and private markets as insane and silly, is Greg Abel's decision to aggressively deploy billions of dollars into acquisitions, share buybacks, and stock talks a brilliant, proactive pivot, or is it a risky departure from Warren Buffett's legendary patient discipline? And this is the crux of the debate surrounding this new leadership. On one hand, you have the classic Buffett purists who argue that Berkshire's strength has always been its patience. Now, as Paul Luntzes, president of Luntzes Asset Management and a long-term Berkshire shareholder, pointed out, it's very hard to want Greg to be making big deals in an ebullient market like now. The private markets are insane and the public markets are kind of silly too. Under this view, the safest move would be to let the cash continue to sit in short-term treasury bills, earnings, safe interest, and wait for a massive market crash to buy assets at a fire sale price. But on the other hand, Greg is facing a reality that Buffett himself acknowledged. A $364.7 billion cash pile is simply too large to remain idle forever without dragging the company's overall return on equity. So by putting $6.8 billion into a tangible business like Taylor Morrison Home and $10 billion into a high cash flow giant like Apple, Abel is really providing that he can find value even in expensive markets, which is the point and the truth of what a good investor can do. And this isn't Abel's first, it's Abel's first go being at the helm of Berkshire, but it's not Abel's first go, or Warren Buffett wouldn't have put him in charge. Now, this isn't a reckless departure from Buffett's principles. It is a pragmatic adaptation, right? Old guard and new guard are going to have some differences. Abel is signaling to shareholders that while he respects the discipline of the past, he will not let Berkshire be paralyzed by its own size. It is a bold, confident start to his tenure, and so far, the doubling of quarterly profits shows the strategy is delivering. And for me, the reason why I bring you these articles and the reason why I talk about these things is so I can give you some insight into things that you might want to go and invest in, as I am rethinking adding Berkshire Hathaway to my current positions.
The new LinkedIn hiring pro can't undo your last hire, the no-show. Who set you back because they didn't show up on day one, or day two, or ever again. And now your product launch is delayed because you're talking to alien abduction podcasters to track them down. But LinkedIn Hiring Pro can help make sure your next hire sticks. In fact, businesses who use LinkedIn are 24% less likely to reopen a role in the next 12 months. Hire right the first time with LinkedIn Hiring Pro. Post a free job today at linkedin.com/quality.
Move over into some crypto markets and Trump markets, I guess you would call it. If you've been following this company, Trump Media and Technology Group Corp, TMTGC, you know they've never been afraid of big headline-grabbing announcements. But yesterday, Friday, August 7th, the company quietly executed a massive multi-billion-dollar strategic retreat, which we thought that might happen, and we've talked about this on Markets Radar before. In a major development, Trump Media ended its year-long agreement with Crypto.com to form a joint digital treasury company. Under the original terms of the deal, which was struck with high hopes a year ago, the digital treasury company was designed to purchase billions of dollars of Crypto's.com native digital token known as CRO, C-R-O. But on Friday, the ambitious plan was officially terminated, and it wasn't the only deal to get left on the cutting room floor. Trump Media and Crypto.com also dropped a highly anticipated plan that would have integrated prediction market contracts directly onto the Truth Social network. On top of that, they canceled a separate arrangement that would have had Crypto.com service certain proposed exchange-traded funds or ETF offerings for Trump Media. When you add it all up, this is a comprehensive unwinding of what was once positioned as a major entry point into the digital asset space for Trump-controlled conglomerate. So what happened? Why did these two giants walk away from three massive initiatives simultaneously? The answer lies in the shifting sands of the broader crypto market. According to the data, this withdrawal marks a clear step back from crypto by Trump Media, driven by a sharp decline in market enthusiasm. Since peaking last year, Bitcoin prices have fallen by nearly half, sliding down to around $65,000. With the price drop, the broader market enthusiasm for token hoarding stock vehicles has severely faded. We got some direct insight into the decision from Chris Marszalek, the CEO of Crypto.com, in an emailed statement. Marszalek explained that after analyzing the proposed ETFs and the digital asset treasury, or DAT, from every single angle, both companies reached the exact same conclusion. Moving forward under current market conditions simply doesn't make sense. So as of right now, DATs don't make sense according to conglomerates in the business. Well, I guess one conglomerate, Crypto.com in this case. So now Marszalek made it clear that Crypto.com isn't giving up on its broader ambitions. He noted that they will continue to actively pursue other ETF opportunities. And as for the massive pile of CRO tokens that has been committed to Trump Media's digital treasury, Marszalek stated that Crypto.com will find a better way to allocate those resources to drive revenue, increase demand, and grow the overall value of their digital ecosystem. While this crypto retreat is a massive story on its own, what makes Trump Media so fascinating right now is that they aren't just shrinking their footprint. They are undergoing a radical corporate transformation. As they pulled back from digital assets, they are pivoting into a completely different frontier, clean energy and deep tech. Back in December, Trump Media announced a massive all-stock transaction to merge with a company called TAE Technologies, Inc. If you aren't familiar with TAE, they are a closely held private nuclear fusion developer founded all the way back in 1998. This merger is valued at more than $6 billion, and once the transaction is finalized, the shareholders of Trump Media and TAE Technologies will each own about 50% of the combined newly merged business. So we are talking about a business that started as a social media platform emerging with a commercial fusion energy developer. This merger has already undergone its own share of twists and turns. When the deal was first announced in December, it initially contemplated spinning off several key assets, including the core social media platform Truth Social. But by June, both companies had reversed course, announcing they were no longer pursuing the spin-off transaction. Truth Social is staying under the combined corporate umbrella, and Trump Media is actively looking for new ways to monetize that social media footprint. Just last month, the company announced a brand new plan to sell real-time access to Truth Social posts. Specifically, they are looking to sell access to points coming from the platform's highest-ranking accounts. It's a clear pivot toward data licensing as they search for alternative revenue streams in a post-crypto landscape. And it is kind of true when we think about it. And that's something I want you to think about. When we think about where all of the money is going, money is leaving crypto, and a lot of it's going into artificial intelligence. Does that mean that crypto is going to be left behind? No, but I do believe that it's going to slow down, and there will be catalysts in the crypto market, but it'll continue to mature, especially if they ever get the crypto or the Clarity Act passed, which helps ring in digital asset infrastructure. But you can even see here now from Trump that even Trump, I know that they're still working on prediction markets with Robinhood. And if I'm not mistaken, I think that was the article that we had talked about on Markets Radar before, with Trump and Robinhood working on prediction markets together. But the problem is that now you can see that Trump, in my opinion, Trump essentially puts and this is how markets kind of work. You put the money where the money's going in the markets and what you think the market's growth are going to be. It could mean that they don't think that crypto is going to have as big of a growth as they once thought, and now they're trying to diversify some of that money out in the other area, or they just think that we need to get through this and clarity, so they're parking money somewhere else, and then they'll come back to these pieces as clarity and bigger infrastructure comes through. So, and when it comes to crypto.com, while their partnership with Trump Media is officially over, the crypto exchange is still commanding massive institutional interest. The company recently announced that the major financial heavyweight Citadel Securities LLC has invested a whopping $400 million directly into the exchange. That investment was completed at an eye-watering valuation of approximately $20 billion. So again, Citadel Securities still believes that there is a big future for these types of markets. My point is that you can see that as certain people who were putting all of their money into, that makes that market volatile. As that market becomes more advanced and more mature, like crypto is becoming, then you will see them move money in and out of it as they see fit based off of what they think that the long-term trajectory of it is. The investment was completed at $20 billion. And again, that's proving that institutional backers are still willing to write massive checks for established crypto infrastructure, even if specialized corporate token deals are losing their shine. So how could we interpret this Trump Media dual track shift, completely abandoning its multi-billion-dollar crypto treasury and prediction markets with crypto.com, while simultaneously merging with a $6 billion nuclear fusion developer in TAE Technologies? Now, it is a classic corporate puzzle, and the answer depends entirely on your perspective of risk. Again, that's what I was talking about with moving money out of crypto somewhere else and then possibly moving it back into crypto. On one hand, you could look at this as a highly pragmatic, necessary maturation of Trump Media business model. A year ago, when the crypto market was soaring and speculative stock vehicles were highly popular, a multi-billion-dollar treasury deal to hoard Crow tokens seemed like an easy way to drive paper value. But as Bitcoin fell by nearly half to 65,000 and the enthusiasm cooled, the risk of holding billions in a single digital token became far too high. Walking away from the crypto.com deal, and Chris Merzlik noted, was simply a rational response to current market conditions. By shifting focus to TAE Technologies, Trump Media, even though it's a media company, is pivoting from highly volatile digital tokens to tangible, long-term, deep technology. Nuclear fusion is the ultimate moonshot bet, and a $6 billion valuation for a company founded in 1998 suggests there is real intellectual property and long-term value there. Combined with their new initiative to monetize Truth Social's top-tier posts, you can argue that leadership is building a more diverse, less speculative business, which is what they should absolutely do. On the other hand, you could argue that this looks like a corporate identity crisis, which I think that exists because of the fact that it's a media company, but retail investors who originally bought into Trump Media did so because of Truth Social and its political media footprint. which they're losing. Now they're looking at a combined company where 50% of the value is tied up in nuclear fusion development. While the social media platform is experimenting with selling real-time post data rather than spinning off as originally planned, it is a massive, highly complex shift in corporate identity, and shareholders must ask themselves if they are comfortable holding a clean energy moonshot instead of a pure play media vehicle. And in my opinion, I would never invest in anything that Trump's involved in, but you and yours have to make that decision up for yourself. We'll be right back.
The new LinkedIn Hiring Pro can't undo your last hire, the no-show. Who set you back because they didn't show up on day one, or day two, or ever again. And now your product launch is delayed because you're talking to alien abduction podcasters to track them down. But LinkedIn Hiring Pro can help make sure your next hire sticks. In fact, businesses who use LinkedIn are 24% less likely to reopen a role in the next 12 months. Hire right the first time with LinkedIn Hiring Pro. Post a free job today at linkedin.com/quality.
For the past couple of years, private equity firms have been in a major bind. Sluggish corporate deal making has made it incredibly difficult to find private buyers for their portfolio companies. But their investors, known as limited partners, are demanding cash payouts. The mounting pressure has forced private equity firms to turn to an exit route that traditionally is viewed as a secondary fallback, and that is known as the initial public offering. Now, public listings are traditionally a fallback because firms dislike the messy, prolonged mechanism of the process, and they don't like exposing themselves to the whims and volatility of the stock market. Plus, underwriters mandate lockup periods, meaning it takes a minimum of 6 months and often years for a firm to fully sell down its shares and cash out. Yet, that path is suddenly looking a lot more attractive, and the numbers prove it. Through August 5th of this year, there have been 21 U.S. listed IPOs of private equity-backed companies. That is the highest number we've seen since the historic boom of 2021. In fact, Blackstone's president, Jonathan Gray, explicitly declared 2026 the year of the IPO. We are seeing this play out across several high-profile names, along major headlines like Elon Musk's SpaceX offering, and we have seen listings from apparel brand Reformation, data center company C Square, and even Jersey Mike's. A perfect example of this shift is the private equity firm Madison Dearborn. They spent years trying to orchestrate a private sale for the defense contract AVEX, even hiring investment bank Jefferies in late 2023 to solicit bids. But when a private buyer never materialized, they pivoted, taking AVEX public in April at a valuation of over $2 billion. Of course, going public is not without risk. Jersey Mike's, which Blackstone took public after 18 months of majority ownership, had a bumpy debut, with its shares falling 6% on its first day on the New York Stock Exchange. If private equity firms still are heavily prefer private M&A sales to avoid public market volatility and multi-year lockup periods, what does this aggressive pivot to IPO tell us about their current health of the broader financial markets? It tells us that pressure to deliver liquidity has reached a boiling point. Historically, only about 1% of private equity exists since the beginning of 2022 has occurred through public listings. Firms would also prefer a clean private M&A exit if they could find one. But right now they can't afford to wait because traditional corporate margins remain sluggish. The newly opened IPO market has become the ultimate release valve. It has also revitalized the dual track process where firms file IPO paperwork to force private buyers to bid higher, knowing they have a viable public backup option if the private bids fall through. It's a clear sign that in today's market, adaptability beats waiting. The cash must flow back to investors, and right now the public markets are the only game in town, and that is all that I'm going to say about that. Actually, that's not true. I'm going to say a little bit more. I think that people should look into the IPO market. Like, the point of Markets Radar and the reason why I want to bring it to people is so that you can get access to understanding different marketplaces. Okay. When we use the word market, we're just referring to a marketplace of buyers and sellers. Okay. I think that an average educated person may know that, but if not, that's okay. That's the reason why you're trying to educate yourself. And so in private equity, in IPOs, in foreign exchange, in real estate, these are all markets where people come and do business to buy and sell things. And my key point is to give you access to understanding and open your mind to go and research some of these other markets, because that is what a mature investor understands and does. And the key here is so that you can build generational wealth, you have to understand this. You have to work to build the wealth, and you have to wrap your family up into understanding of how to build this type of wealth moving forward. Business and investments should be a part of how you're teaching your children, how your children are getting educated. It doesn't mean that that needs to be their number one goal in life. Like if I could go back, I would have studied ethnomusicology, musicology, and investing, right? I would have spent my time investing in deals, doing side projects, building businesses, and spent my time as a PhD in ethnomusicology and musicology. That's what I would have preferred to do with my life. Okay, that's just the honest truth of it. But again, the point is that for you to build actual wealth, I'm not going to build the wealth being a musicologist. Right? I'm going to build wealth by being a musicologist that also invests and to get into other projects. Investing in business needs to be ingrained in all of the things that we do if we're going to play the game that's in the United States. That doesn't mean that you can't work to make capitalism better. It doesn't mean that you can't introduce socialism. It doesn't mean that you can't fight for the things that you believe in. But the key point of a man in society is to take care of his family and his clan, in my opinion. And my principles are compassion, integrity, leaving the world better than I found it, and building the clan, protecting the clan, and growing the clan. All right, to close out this Markets Radar, let's talk about Japan. For months, one of the most crowded and profitable trades on Wall Street was shorting the Japanese yen. Speculators have been aggressively ramping up wagers against the currency as it slid to its weakest level since 1986. This decline was driven by a massive gaping interest rate differential between the high rate environment in the United States and the ultra low rate policy in Japan, which is traditionally known as the reverse carry trade. But in a sudden and violent reversal, the massive short trade has completely imploded, as all things do when they get over leveraged or when they get over, ballooned up. According to the latest Commodity Futures Trading Commission data, leveraged funds have slashed their net short yen positions by roughly half, cutting them down to 63,600 contracts as of August 4th. To put this massive retreat into perspective, just at the end of June, those bearish bets had swelled to nearly 138,000 contracts. That was the largest net short position against the yen recorded since 2007. So what caused this stampede of hedge fudge rushing to cover their short positions? It was a classic 1-2 punch. I don't have a punch sign, so I'm going to do the cash sign again. I don't know if I hit the right button. I didn't hit the right button. Hold on. There it is. We'll add a punch sign. Punch! If you guys watch Mercury, we have a little, what we call a D-slap. I don't know if this show requires that, but you can check out Mercury if you're interested in that. So it was a classic 1-2 punch. First, coordinated efforts by U.S. and Japanese officials intervened directly to stabilize and support the currency, which immediately forced traders to rethink their massive bearish wagers. Second, the macroeconomic landscape supporting this trade is shifting rapidly on both sides of the Pacific. While the Bank of Japan decided to keep its benchmark interest rate unchanged, the market isn't expecting them to stay quiet for long. Overnight index swaps now imply a strong 70% probability that Japan will raise interest rates by September. At the same time, the U.S. side of the equation is weakening. Friday's softer than expected U.S. employment report dragged down the dollar by severely dampening expectations for further rate hikes from the Federal Reserve, which I don't think is true. I still think they're going to do a rate hike. Traders have aggressively parried back the chance of a Fed rate hike next month to just 40%, down from 60% before the payroll data dropped. With Japan poised to hike and the U.S. poised to hold, the interest rate gap is narrowing and the yen has rebounded fiercely. Given that hedge funds have just cut their bearish yen wagers by half, does this dramatic unwind signal a permanent turning point for the yen, or are we just seeing a temporary policy-driven short squeeze in a structural bear market? This looks like a fundamental structural shift rather than a temporary blip. While the trigger was coordinated U.S. and Japanese intervention, the real fuel for this rally is the shifting interest rate outlook. For years, the yen was anchored by Japan's near zero rates, while its Fed hiked aggressively. Now, the gap is closing from both directions, with Friday's weak U.S. job data cutting the probability of another Fed hike next month to 40%, and swaps and swap markets pricing in a 60% chance of Bank of Japan hike by September, the mechanical driver behind the yen short trade is dissolving. Hedge fund recognized that staying short against coordinated central banks and narrowing rate differential was highly dangerous, leading to this massive historic retreat. The currency wars are shifting, and the yen bears are officially on the run, and that's why I was buying up some Japanese yen. And that's why you read as much news as you can. I get these from my the news articles that I use in this podcast. I use Bloomberg's a lot. I use Wall Street Journal. I use Market Watch. I use Barron's. I use Investors Circle inside of Barron's, and I use The Economist. So my sentiment is get a subscription to all of those. Go and follow all of them on X. Set up notifications. They'll send you notifications of news articles. Essentially, you can look at them, and then you can hit that on X, and it will bring you over to the article itself. And that's how I read my news, I guess. Vis-a-vis X, vis-a-vis subscriptions, vis-a-vis reading. Reading is the best. You should read more. And we'll see you next Tuesday on Markets Radar. As I always say, be thankful, grateful, and kind. We'll talk with you soon. Bye.